The next financial power shift may not start with a price chart. It may start with the rails nobody notices until the global financial system is already deeply dependent on them. And that is why this conversation matters. Because if institutions become dependent on digital settlement infrastructure before most people fully understand who controls it, then the real battle may no longer be which crypto asset wins. The real battle may become who controls the system's money eventually has to move through. And the dangerous part is that by the time most people recognize the dependency forming underneath global finance, the infrastructure itself may already be deeply embedded into everyday financial activity. That changes the entire conversation around stablecoins, the XRP Ledger, blockchain settlement systems, and global financial infrastructure. But this is also where many XRP holders may still be misunderstanding the deeper issue, because infrastructure growth alone does not automatically force XRP coin itself to become structurally required underneath the system. And this is why the XRP Ledger and XRP coin still must be separated clearly in this conversation, because the XRP Ledger can continue growing institutionally, while XRP coin itself still remains optional inside many settlement flows, and that distinction matters much more than most people realize. Infrastructure dependency and bridge asset dependency are not necessarily the same thing, and that distinction may ultimately determine whether XRP coin remains optional or eventually becomes structurally difficult for global liquidity systems to avoid. That is the hidden transition almost nobody in crypto fully understands yet, because many XRP holders may spend years focusing only on price action, while infrastructure dependency quietly hardens underneath the financial system itself. And if that transition continues forming globally, the market may not immediately reflect where long-term financial influence is actually consolidating. That is where the situation starts becoming much bigger than crypto prices, because financial systems do not become dominant simply because they exist. They become dominant when enough governments, banks, payment providers, liquidity networks, and institutions standardize around them long enough that leaving eventually becomes inefficient, disruptive, or financially dangerous. That is how dependency forms, slowly at first, then all at once the infrastructure becomes unavoidable. And this is why the stablecoin conversation may become much bigger than most people currently realize, because if stablecoins continue scaling globally, the most important issue may not simply be whether transactions move faster. The real issue may become who controls issuance, reserve infrastructure, transaction visibility, liquidity access, settlement permissions, compliance frameworks, and the digital rails global finance eventually becomes trapped inside. That is the hidden layer most people still are not paying attention to, because once enough of the financial world standardizes around the same digital settlement layers, the issue may no longer be whether those systems are efficient. The issue may become whether the world still has meaningful alternatives left. And this is where many XRP holders may completely misread what is happening underneath the system, because from the outside, stablecoin growth may simply look like another crypto trend or another competitor entering the market. But underneath the financial system, dependency may quietly be hardening around the infrastructure layers themselves. And once enough value starts moving through the same systems repeatedly, control over those systems becomes strategically important. Standards become important, liquidity access becomes important, settlement permissions become important, compliance dominance becomes important, infrastructure dependency becomes important, and eventually financial influence may begin shifting toward the entities controlling the rails underneath global liquidity movement itself. That is not speculation, that is how financial infrastructure has historically evolved. But this is where the XRP Ledger and XRP coin distinction becomes critically important again, because even if stablecoin infrastructure continues scaling globally, the deeper liquidity problem underneath the system may still remain unresolved. Stablecoins can digitize fiat movement more efficiently, but they do not automatically eliminate fragmented liquidity management between disconnected currencies, jurisdictions, reserve systems, and banking structures globally. That is the real issue bridge asset systems were originally designed to address. Because the real long-term problem may not simply be how to move tokenized fiat faster. The real problem may eventually become how to reduce the operational burden of maintaining fragmented liquidity systems underneath global finance altogether. And if global settlement expectations continue accelerating while fragmented liquidity pressure keeps compounding underneath the system, then bridge assets may eventually become far more relevant later in the cycle under the right global conditions. That is the part most people still are not connecting clearly enough yet, because once global liquidity becomes deeply routed through the same digital settlement layers repeatedly, financial systems can slowly become trapped inside infrastructure they no longer control as easily as they once did. And by the time most people realize how much influence sits underneath those rails, disconnecting from those systems may no longer be simple operationally, economically, or politically. That is where the next major financial power struggle could eventually emerge, not simply between crypto and banks, but between competing models of infrastructure control. And this is why watching price action alone may completely distort how people understand what is actually happening underneath global finance right now, because the deepest transformation may not begin with speculation. It may begin with infrastructure dependency quietly hardening underneath the system long before most people fully recognize it. And if dependency continues consolidating around a small number of dominant settlement networks globally, the future of finance may become less about open competition and more about who controls the infrastructure layer the rest of the financial world becomes dependent on. That is the shift most people still cannot see clearly yet, because the future battle may not simply be about blockchain adoption anymore. The future battle may become about infrastructure control itself. And in the next episode, we're going to break down the next question almost nobody is asking yet, because if infrastructure control eventually becomes the real battlefield, then the most important issue may no longer be speed or adoption alone. The real issue may become what happens when governments, central banks, institutions, and private financial networks all begin competing for influence over the same digital settlement infrastructure globally, and why that battle could eventually reshape monetary power itself.